hosting the G20 this year. Australia would be a country that would benefit from a normalization of monetary policy in the major centers in the OECD, because at the moment the Australian Central Bank is caught between a rock and a hard place. They have historically low interest rates, but they still pay interest rates. There still is the prime rate is at 2.5%, which is about 2.5% more than the European Central Bank pays, and this results in an overvaluation of the Australian dollar, which makes it difficult for Australian businesses to compete on global markets. So when monetary policy will return to a more sustainable kind of path, this will have negative effects for some countries, but it will also have positive effects for other countries like Australia, that will regain some policy space which they don't have at the moment as a consequence of this ultra-loose monetary policy. It will, and this is something that is not intensely discussed in Europe, but sooner or later it may come up. It will also force private households in Northern Europe, an issue that has not been on the agenda for a long period of time. It will force them to do what the Americans have done since 2008, i.e. reduce the extremely high levels of private debt of private household debt. Denmark is leading the field, so to speak, with private debt of 330% of annual income. That is not sustainable, and that has been rising due to the very low levels of interest rates, and that is a dangerous path. Last point, and I think this is what we should also discuss in the context of the G20. What can countries do about that? What can countries do to protect themselves against the negative effects of ever greater interconnectedness and consequently greater vulnerability? You can do two things. One is you generate current account surpluses. This is immunizing an economy. If you generate current account surpluses, you are not kind of subject to a reduction of capital inflows, and of course not all countries can follow that path. It requires other countries to accept deficits, and for a country like India with a rapidly growing population, it would of course be foolish to aim at this avenue. So what is the second option? And I think the second option we should discuss much more intensely, and we have evidence of countries that have applied such policies with success in recent years. The policy to be discussed is a policy that tries to slow down, not prohibit, slow down capital flows by taxing inflows or by using what Chile did in the 1990s, courtesy to the Chilean-US free trade agreement. They can't do that anymore, but they did it in the early 1990s, where they had an unremunerated reserve requirement when you imported capital into Chile. What the Brazilians did after 2008 was much simpler. They had a tax on inflows, first 2, then 4, then 6, and now 0%. Which kept some of, as the Economist calls it, some of the hot money out, so it kind of stabilized flows. And I think this is something that many more countries should be considering in the time of the boom, to slow inflows down in order to prevent a nasty wake-up, a nasty kind of hangover when capital is flowing out of the country again. And final point on the G20 and what the G20 could do about that. Of course, the G20 could try to harmonize monetary policy. But I think this is wishful thinking. It hasn't worked in the G7, and it will not work as long as countries pursue monetary policy based on the interests of their societies. Probably they are not to be blamed for that, but as long as they do what is good for their country, and as long as countries implement monetary policies that are exclusively considering the effects of monetary policy on their economies and are ignoring the effects of monetary policy on the rest of the world, we have meetings like the G20, but they will not result in a reduction of vulnerabilities, and they will not, I am afraid, result in the kind of harmonization of interest rate policy over the entire spectrum of G20 membership. So we have to think about other instruments, and they also have to be implemented at the national level. And with that, I would like to close, and thank you for your attention.
Thank you, Heribert. Barry, would you like to come up? Okay, well, we have about 35 minutes, Rajat, for a discussion now. We can take 5 minutes off. Yeah, great. 12:45 normally means 1, so I kind of figured. Great, that means we have lots of time. I just want to make one comment or a question, Barry's here, which is that, one salutary effect G20 has had is that the US, in a sense, has been forced to systematize forward guidance. I can make that claim for the G20. It may not just be the G20. I don't realistically see what else the G20 can do in terms of, both the window for forward guidance and the envelope and the information sharing that's now there. So isn't it time that we just drop this from the G20 agenda? Because I'm getting this uncanny feeling that for the past 3 years I'm listening to the same arguments. And it's okay, I mean, it's only the G20. If they have achieved something and it's not going to be realistically possible to achieve something else because of asymmetries in the world that we all know, then on this, as many other issues, I think perhaps the G20, Barry, this is for your ears, needs to take a call on what to drop going ahead to Turkey. And maybe this is one of those areas. It's tempting not to drop it because you have a stakeholder here, this entire central bank stream. And they don't like to drop it because that's what they do. But there are compelling arguments, in my view, I'm being provocative, to drop it, and it'd be interesting to get your views on this. Many other things too, but certainly this one, which is the beloved of finance ministries and central banks, I think it's you've done what you can do now, don't push it. Interested to hear your views, for or against. The floor is open. Questions to Barry. If you could identify yourself, and if you have a specific question for Barry or someone here, please let me know, and I'll collect 3 or 4 at a time, please. Could you identify yourselves, please?
Yeah, I'm Abhik. I work for ICRIER. Just moved to ICRIER recently from HDFC Bank. I just had an observation and wanted a response from Subir on why the markets were taken by surprise, by the emerging markets, particularly in May. My sense, and I sort of track the Fed minutes and the statements quite carefully, is that until then, or a couple of months before that, the market's judgment was that the withdrawal of QE would be premised on conditions in the labor market and inflation expectations. But suddenly a third element, and this is something I was discussing with Professor Bhagwati yesterday, entered the picture, which was the issue of the quality of paper that was being issued on the back of very high liquidity. And you had an activist regional Fed president, Heller, I think, of Kansas, sort of who brought this up. And that sort of really turned the debate. And the markets was somewhat caught by surprise because you had, labor market conditions were very weak. They were at around, the unemployment rate was about 8%. There was no trace of inflation expectations, either from the tips or from actual CPI data. But suddenly it was this quality of paper, the issuance of junk bonds and the like, which really somewhat induced the Fed to make the first statement about its intent to taper. And I think that was one of the reasons, at least, that the markets were surprised. I don't know what your view is on this.
Thank you.
I have a question to Alok and Subir. I'm Chandra Tukorle from Australian National University. Now, when you look at what has been happening in world capital markets over the last 6 months, interest rates have been dropping, both short-term and long-term. And even some countries with doubtful creditworthiness like Pakistan have been borrowing massive amount at historically low interest rates. How do you reconcile that situation with continuing tapering of quantitative easing? I think in addition, I'm trying to understand it in terms of the 3 factors Subir pointed out, but still I'm a bit confused. Capital markets have been calmer, interest rates have been dropping, and emerging market economies are borrowing both short-term and long-term in big amounts in recent months.
Thank you. Yes, Professor Bhagwati.
Thank you. My question is for Mr. Daita. You referred to the Brazilian move to impose a certain tax, so to speak, on foreign exchange inflows. Some other countries which have non-convertible capital accounts have at times chosen to build up foreign exchange reserves. Now, were you consciously suggesting that imposing a tax is a better way, or should we say in terms of the global good, or in terms of a G20 kind of, since this is a G20 forum, it's a better, or lesser of the two evils, rather than saying one is better than the other?
Is there, yes, Ashima, and then we'll come back to the panel.
Yeah, this maybe to Subir or Daita, it's a joint question and two different issues. One is this thing about costs versus benefits. The costs of QE were largely borne by emerging markets. I think all those commodity price increases and so on. But the benefits will go to both advanced economies as they recover and to maybe emerging markets. So there's an asymmetry here. And the G20 is supposed to, and all right, maybe the US is recovering, so it's working out and things will not backfire, it will go smoothly. But the G20 is supposed to be forward-looking or set in place a global financial architecture which does not lead to this kind of asymmetry and prevents future such risks occurring. So we should not think that it might work out and therefore nothing should be done. But the kind of issues Dieter was raising, think of some other instruments, and maybe this tax issue, because one country alone is really afraid to think of any tax. But if there's a universal agreement on something which has a prudential role, because there are, the financial reforms are also not going. There are last minute, everybody's trying to get out of it. So G20 should push some kind of changes in the global financial architecture, which would slow down these kind of surges, short-term capital, and all countries should do it. In particular, the source countries of this capital. Yeah, thank you.
Thank you. Who would like to go first? Subir, maybe Alok?
So I think most of the questions are addressed to those on my side, but the first question is why emerging market, despite the tapering, they're able to access capital markets at such low costs. And to that, I don't know, perhaps Subir will be in a better position to answer that. But since it's only the balance sheet, it's only the rate of increase in the balance sheet which is reduced so far. It is still increasing. It is still not shrinking, so there is more liquidity still being pumped in. Now, what would happen once the balance sheet starts shrinking? I suppose that would be the next sort of threshold. Once it starts shrinking, then perhaps you might see more of a rise in costs. That is what my sort of gut feeling is. And the second issue on imposing tax versus flows and building reserves, I think it would also to a great extent depend on where you're coming from. If you're coming from a deficit country and where you can be quite adversely affected in a sudden stop situation, I would think you would tilt towards reserves. If you're a surplus country, then now, Brazil was, I think at the time when it was very critical of, QE, at that point, I think it was a surplus country.
Yeah. Yes, it was.
Yeah. India was not too, I mean, we were not at all vocal on our criticism of, QE. We sort of tagged on. But we have become vocal at the time when, there is a withdrawal, at the time of exit. So it depends on where you are from. And in terms of again, the EMEs, which at the time of exit, EMEs which are surplus would perhaps tend to gain from, to some extent, from the exit, whereas again the deficit countries would, there could be some sort of a panic. That is.
Let me start with the second question. And if I understood it correctly, you were suggesting that within the G20 there should be a consensus on how to kind of slow down capital flows and implement policies jointly. Where the difficulty is that there doesn't seem to be much of a consensus on the utility of capital flows within the G20. You could simply argue that the perspectives on capital flows differ within the group. And there will not be a consensus, I dare say, on any kind of measure to slow down capital flows. So countries have to do it individually or just live with the existing situation. We do, and this is a matter of great concern for Europeans at the moment, we do, of course, notice that the G1 is moving ahead unilaterally without talking to the Europeans on a number of fronts. And one is banking supervision. The United States is implementing a new form of banking supervision, and without having asked anybody whether the Europeans like it or not, which is a departure from the established principle of home country regulation. Deutsche Bank is regulated and supervised in Frankfurt, to the principle of host country regulation. All banks that are operating in the United States and have a balance sheet of about $50 billion have to hold the capital in New York. And it is no longer accepted that the capital is held in Frankfurt. Now you ask yourself, is that in the spirit of the transatlantic trade and investment partnership? Probably not. It is a contradiction. We talk about the harmonization of standards in one room, and then we talk about what the economist has been calling the balkanization of finance in the next room. So as much as I would like to support your proposal, I do think that at the moment in this world of 2014, the preferences of countries, including India, are differing so sharply that it is very difficult to organize global governance, not just in finance, but also in finance. And that is a big problem. And even for two kind of continents that seem to be close to each other, the US and the European Union, we have that sharp divergence when it comes to the regulation of finance. Very difficult at the moment. And yes, Professor Bhagwati, I would say it's the lesser evil. Considering Mandel, Fleming, trinity of international finance, one has to choose between either unrestricted capital flows or wildly fluctuating exchange rates. And if taxes that are imposed temporarily are kind of contributing to enhancing stability, then I would prefer them over what China has been implementing in the last 30, 40 years, complete restriction of capital flows. As we all know, China is now trying to find a new way in the Shanghai pilot zone in which they will have unrestricted capital flows and still have a fixed exchange rate. I wonder how they will manage to do that. I think this is Barry Eichengreen has suggested that it will be extremely difficult to do that. And at the end of the day, if you would ask me whether a country like China or India would be better served with having that tool ready at their disposal whilst otherwise liberalizing both the current and the capital account, I think it would be exactly as you said, it would be a lesser evil. It's not a perfect instrument, but given the benefits that could derive from it, on balance, one could perhaps argue that it would be a useful addition to the toolkit of policymakers.
Yeah, I just want to, before I hand over to Subir, point out a practical problem in this business, which was faced when I served in Brazil by the Brazilians. So you have a firm that comes in and it brings in capital flows in 5 tranches. and the first two are not taxed or taxed differentially, and the third or fourth are taxed, the firm can go to court saying that that was not part of the contract. You can actually have contract failure, and that was something the Brazilians faced. But because countries like India have much weaker contractual systems, that would be, a major factor in being cautious about such an on-the-tap tax instrument. Subir.
Yeah, to Abhik's question, I think that may explain the trigger, but I'm not sure it explains the transmission. And to me, from looking at it from the emerging market portfolio perspective, ultimately what sort of both caused the slide and kept it going for so many weeks and months, in fact, I think was the composition. That to me was the dominant factor. So there may have been several triggers, and we've seen this in other shock situations as well. I mean, you look at 2012, that was essentially a domestic shock, but again we had a 6-7 week kind of a slide. And so macro fundamentals and composition, I think, combined there. So I don't have enough background on this issue you're raising, but I would see that as a trigger factor rather than a transmission factor. Chandra, I think very simple explanation in the context of my factors. One, there is increasing appetite for longer dated assets. That's consistent with the explanation that portfolio preferences are changing. Two, these countries are presumably being advised by their bankers that, hey, look, there is an appetite. If you want to borrow now because rates are going to go up soon. So issue now rather than wait. So I think the combination of supply and demand factors is causing this surge or increase in issuance. Earlier, you could have said low rates, but there wasn't enough appetite, I think, for them to be predictably placed. So I think that balance of supply and demand factors has changed somewhat as a result of the changing portfolio preferences. Ashima, your point about basically you're looking at a first best global central bank, right? That's essentially what the ideal situation seems to be when you have such intense spillover effects from the actions of any specific central bank. Let's take that off the table. That is not even a fantasy. Forget about anything close to reality. But then you have two mechanisms that so provide a second best, which I think the G20 has been dealing with quite directly. One is the safety net issue, and this then goes back to the international monetary, the international financial architecture debate on whether we need to reconstruct both the IMF and the other sort of multilateral arrangements, allowing countries access to safety nets without imposing significant domestic costs. Because ultimately you can always go back to self-insurance and reserves and say, no, I cannot trust anything that's outside my control, so I will just keep piling up reserves. That has other consequences as well. So how do we get, if we can't have a global central bank, how do we buffer economies from negative spillovers? That's the one part of it is the international financial architecture. The other is the harmonization or coordination of regulation, essentially, cross-border resolution issues, and so Basel III is one component of it. That's been the first one off the blocks. That's the first one that has been implemented. There are more complicated issues with resolution, which I don't think have yet reached any conclusive point. But basically what the G20 seems to be realistically capable of doing is to keep pushing these two safety net agendas in the absence of the first best.
Well, the first point is you're not going to stop G20 ministers and central bank governors thinking this is an important issue, because I reckon it's the main reason they turn up in the first place, to have this discussion. The first session on the global economy is critical, and sometimes the words that come out in a communique don't fully enumerate that for obvious reasons, but I think that's a critical element of international governance at the moment. And while, as Subir said, global central banks are not even a fantasy, the the quality of discussion between the central bankers and with the finance ministers and the major international organisations. Improving that has been one of our objectives this year, and I think that's been happening. The quality of discussion inside the room and some of the probing of each other's positions is one of the main reasons why you have a G20 and the finance minister. That's still a steering committee element, and I think it has been a very rich discussion. All the risks that have been raised in this room today are discussed in full. And this is all a balance of risks issue. We can talk about the risks from unconventional monetary policy, but I think in Europe now you're seeing some of the risks of not doing it. You're having a fall in inflation and some evidence of inflation expectations, and so we've been focusing a lot about the Fed, but I suspect the big issue coming in Cairns is actually going to be about the different positions of the different major central banks and how that has to be resolved. And so this is discussed very actively. I think it's not right just to think about the risks of exit in isolation. It's the circumstances under which exit happens that matters for spillovers. If it's happening because we have stronger US and then hopefully European economies, that has an entirely different impact on the rest of the world, including Australia and India, than a situation where interest rates are rising without that real activity. And so these are discussed all the time. I think there's also been quite a big change in the consensus about capital flow controls, macroprudential policy. So there is much more acceptance and tolerance that they're valid instruments. There's some frameworks around those instruments, like not making them distortionary and that sort of thing. But the world's moved on a lot from the Washington consensus of 6 years ago because of the operation of the crisis. So I don't think this sort of characterisation that people are just talking about these instruments without thinking about some of the tools is actually right. There's a much more acceptance that these are part of the policy toolkits, even if they're a little bit untested at the moment. And just finally, I think someone mentioned the low interest rates from bond issuances in quite marginal sovereign. I think it's important that we don't sort of attribute everything to unconventional monetary policy. Sometimes markets can display evidence of underpricing of risk in any stage of a monetary policy cycle. I think the risks go up when you've kept interest rates for low for long periods of time, but one of the critical elements of the G20 has to be scanning the financial world for risks and being aware and ready to use all policy instruments to respond to those risks. So I agree there's some things out there that we need to keep an eye on, but I don't think it should always be wrapped up in an unconventional monetary policy taper type narrative. I think whatever the stage of the cycle, one of the critical things we found from the global financial crisis is that financial markets can affect the real economy faster and harder than you imagine. And so one of the critical elements of a G20 is having a very active and constant discussion of those risks, scanning them, thinking about the right policy tools, discussing openly the balance of those risks, pressing each other, and hopefully that will produce if not the perfect optimal international macroeconomic arrangements, a lot better arrangements than would happen without that conversation.
If I may just sort of take you up on that a little bit. I mean, if what you're saying is right, then yes, then I think the G20 has found a role which is very valuable, which is to identify risks and talk about them. But that was not, especially in this case, as you said very rightly earlier, the expectation to the G20 when it was founded. The idea was that it would do all this and there would be concerted, coordinated action to mitigate some of these things. And I think part of the discussion on tapering is that, as Ashima was saying, is the costs and benefits of whatever has happened asymmetrically. And that goes against, if you like, the initial value proposition of the G20. Now, it's